You're sitting in a small office at the back of the dealership. There's a guy across from you moving numbers around on a printed sheet, adjusting this, extending that, and every few minutes he turns the page towards you and says, "How does that look?" And each time you're staring at one number, the monthly payment. And eventually the number on the page matches yours, or gets close enough, and something in you relaxes because you stayed under the limit. You held the line. You did what you set out to do. You drive home in a new car feeling like the responsible one, like you thought it through. But here's what nobody told you before you walked into that room. The number you were protecting, the one you'd calculated at home, the one you felt good about, was never your protection. It was your weakness. And the moment you said it out loud, the entire deal reorganized itself around it. My name is Alex, and I break down how the monthly payment ceiling actually plays out for people dealing with the quiet financial damage of a car deal that felt disciplined but wasn't.
All right, let's get into the numbers, because this is where the picture becomes impossible to ignore. Say your ceiling is $500 a month. You've decided that's your limit. You walk in with that number, and a salesperson who has done this thousands of times now has exactly what they need. Here's how the math gets quietly shaped around your ceiling rather than around your actual financial interest. A $500 monthly payment on a 60-month loan at 7% interest, roughly the current average for a new car loan, supports a vehicle priced around $25,000 after your down payment. Reasonable, mid-range, nothing extravagant. But stretch that same payment to a 72-month loan, and it now supports a $29,000 vehicle. Push it to 84 months, 7 years, which is now one of the most commonly offered terms in the country, and that same $500 payment covers a $33,000 car. Same payment, $8,000 difference in vehicle price, just by adjusting how long you pay. And this is the number that surprised me most when I first laid it out. On the 84-month loan at 7%, you will pay approximately $12,000 in interest over the life of the loan. On the 60-month version, it's around $4,500. The longer term costs you an extra $7,500 in interest while delivering the exact monthly number you asked for. Your ceiling protected you from nothing. It just determined how the deal would be structured to extract the most total revenue while appearing to respect your limit. But here's where it gets uncomfortable, because the term extension is only the first move. Once your ceiling is established, the finance office has a second tool, and it's quieter. Every add-on product gets evaluated not by its actual cost, but by how many dollars per month it adds to your payment. The extended warranty that costs $1,800 doesn't get presented as $1,800. It gets presented as $26 a month over the remaining term. Gap insurance becomes $15 a month. A paint and fabric protection package runs $12. Tire and wheel coverage adds $9. Individually, none of those numbers trigger alarm. Together, they've added $60 to $80 to your monthly payment and several $1,000s to your total loan balance, and you're still inside your ceiling. The deal still feels like it fits. You still walk out feeling like you stayed disciplined. Let's look at the full picture. You came in with a $500 ceiling. You leave with a $492 payment. You feel like you won. But you're on an 84-month loan for $31,000 with 4 add-on products rolled in, paying close to $11,000 in interest over 7 years on a vehicle that will be worth somewhere around $12,000 by the time it's paid off. You spent $42,000 total on a car currently sitting in your driveway worth $12,000. And every step of the way, the monthly number stayed inside your limit. Now here's the part nobody really talks about. What does 7 years of $500 payments look like somewhere else? $500 a month invested consistently at 8% average annual return, a historically grounded expectation for a broad index fund, grows to approximately $57,000 over those same 84 months. Not a guarantee, just math. $57,000 in an account you own versus a $12,000 asset depreciating in your driveway. That gap, $45,000, is the real cost of the ceiling strategy, not the payment, the opportunity.
Here's what I want you to sit with for a moment. The monthly payment ceiling is not a bad idea you had. It is a completely logical response to how car buying gets framed in this country. The instinct to set a limit is sound. The problem is that the limit operates in a unit of measurement that the dealership controls entirely and has spent decades learning how to work around. This didn't happen by accident. Starting in the 1980s, as vehicle prices began climbing faster than real wages, the automotive industry made a calculated shift toward payment-based selling. Advertisements stopped leading with price and started leading with monthly figures. For just $3.99 a month, the psychological anchor moved from the total cost of the vehicle to the monthly commitment. And once that shift happened in marketing, it became the default language of dealership negotiations as well. And this is where things quietly changed for American consumers, because the moment the monthly payment became the unit of measurement, something else became possible: loan term creep. In 1980, the average car loan was around 36 months. By the early 2000s, 60 months had become standard. Today, according to data from Experian, nearly a third of all new car loans are for terms of 73 months or longer. That's not because cars became more reliable or consumers became more sophisticated. It's because longer terms are the primary mechanism for keeping payments artificially low while prices keep rising. The term absorbs the gap between what people can afford monthly and what vehicles actually cost. But nobody really talks about what that term creep does to your financial position in the years right after you sign. When you stretch a loan to 72 or 84 months, your car loses value faster than you pay down the principal in the early years. For the first 2 to 3 years of a long-term loan, you owe more than the car is worth. If it gets totaled, stolen, or you need to sell it, you still owe the lender the difference. That's the gap that gap insurance is designed to cover, a product you're being sold to protect you from a problem the loan structure itself created. And here's where it gets even more layered. The dealership doesn't profit only from the vehicle sale. In many cases, the finance office is where a significant portion of dealer revenue is actually generated. When a dealer arranges your financing through a preferred lender, they often receive what's called a dealer reserve, a portion of the interest rate markup above what the lender actually requires. You might qualify for 5.5%, but the dealer presents 7%, pockets the difference over the life of the loan, and you never see that number broken out anywhere on the paperwork. None of this is illegal. All of it is designed. And understanding that it's designed is what changes everything, because it means the discomfort you feel when you look at the full math isn't confusion, it's clarity arriving a little late. Your situation makes complete sense. You walked into a system built by professionals, optimized over decades, specifically calibrated to feel fair while working against your long-term interest. That's not a personal failure. That's an information gap.
So why does the ceiling feel so protective in the moment, even when it isn't? It comes down to how the brain handles complexity under pressure. Buying a car involves a genuinely overwhelming number of variables: vehicle price, trade-in value, interest rate, loan term, add-on products, insurance implications. And the dealership environment adds time pressure and social dynamics on top of all of it. When the cognitive load gets high enough, the brain reaches for a single rule it can hold on to: a ceiling, one number to keep steady while everything else moves. The ceiling feels like control because it is a form of control, just not the form that actually protects you. It controls one variable while leaving every other variable open for someone else to optimize against your interest. But here's where things quietly change. There's something deeper happening underneath the math, and it's worth naming. For a lot of people, a car is genuinely tied to identity, not in a shallow way, in a real, functional one. The car is what takes your kids to school. It's what gets you to the job that funds everything else. It's what coworkers and neighbors see. And when you've been driving something old or unreliable or that quietly embarrasses you, the upgrade doesn't just feel like a transportation decision. It feels like arriving somewhere, like becoming a version of yourself you've been working toward. That emotional charge is completely valid, and it's also exactly what makes it hard to think clearly about numbers at the point of purchase. When a decision carries identity weight, the brain shifts into a different mode. Justification becomes easier. The monthly payment feels like a reasonable trade for something that actually matters. The pride of staying under your ceiling is immediate. The cost of the extended term, the buried add-ons, the accumulated interest, those arrive slowly, month by month, for years. By the time the full cost is visible, the original decision is long past the point of revision. You're just living with it. And there's one more layer that doesn't get talked about enough. Car payments have become so normalized in American life that not having one can feel genuinely unusual. When everyone around you seems to have a new car and a $500 payment, the payment starts to feel like the natural cost of participation, not a choice with real alternatives, but just what cars cost now. That normalization makes it harder to question. It makes the ceiling feel reasonable, rather than like the first move in a negotiation you might be losing.
The shift worth making here isn't about becoming someone who refuses to finance a vehicle or haggles aggressively over every line item. Most people need cars. Financing is a legitimate option. That's not the conversation. The shift is simpler. It's about which number you actually protect. The monthly payment is the dealer's number. The total cost of the vehicle, purchase price plus all interest across the full loan term, is your number. Those two figures do not move in the same direction. When a dealer stretches the term to honor your monthly ceiling, your number goes up, even as theirs stays within your limit. They respected the boundary you set, and it still cost you more. If you walked into every car purchase asking, "What is the total amount I will pay for this vehicle by the time the final payment clears," and held that as your actual ceiling, the entire negotiation changes shape. The term matters. The rate matters. The add-ons become real dollar figures instead of monthly increments small enough to wave away. The full picture comes into focus, and you're negotiating on ground that works in your favor rather than theirs. That's not a tactic. It's just a different unit of measurement, one that happens to reflect what the car actually costs.
If you're already in a long-term car loan right now, this is not a reason to spiral. The decision is made, and the most useful thing you can do is understand your remaining position clearly. Pull up your loan details, look at the total interest still owed, and know that paying even a modest extra amount toward principal each month can shorten the loan by a year or more and save thousands. Not dramatically, just quietly over time. Progress is still available from wherever you're standing. If you're approaching a car purchase soon, build one habit before you walk in. Calculate the total cost, not the monthly payment, at multiple loan terms. Same car, same rate, at 48, 60, and 72 months. Look at the total payment column. Let that number be the one you protect. And when someone in that back office asks what you're looking to spend monthly, you don't have to answer. "I'm focused on the total price of the vehicle" is a complete sentence. It changes the entire dynamic of what comes next. If this landed for you, or if you've been through a car deal that looked fine on paper and felt different a year later, I'd genuinely like to hear about it in the comments. You're not alone in that experience, and more people need to understand that this is a system issue, not a personal failure. If this video was useful, subscribing means you'll see more of these. Honest, grounded breakdowns of the financial decisions most people are navigating without the full picture. Thank you for watching.